Greetings, my name is Ted Hicks. I'm the founder, the CEO, and the Chief Investment Officer for Hicks & Associates Wealth Management. Today is Thursday, June 30th, 2022. We're shooting this video a day early in the hopes that we can get it polished and published by July 1, Friday, so everybody can watch it over the long Independence Day weekend. That said, certainly hope you enjoy a nice long weekend celebrating the founding of our nation. We certainly hope you enjoy it safely. That said, before I forget, if you do like these videos, we do ask that you hit the like button, give us a thumbs up on YouTube, and if you're on YouTube, please make sure you also hit the subscribe button. Those types of actions do help the algorithms and help our videos get shown a little bit more frequently. That said, please also feel free to share these videos with friends, family, colleagues, whoever you would like to share that with. We're seeing a lot of interest in the work that we do from others who are not managing portfolios the way that we are. So by all means, please feel free to share these videos with others. It is a great way to introduce folks to the work that my team and I do. So that said, let's dive in. First up is a quick review of the S&P 500. On the chart right now is a monthly candle chart. So each one of these candles represents a month in time. And I've got it color-coded to coincide with the vertical speed indicator. Again, that is an indicator that is a roll-up of 14 individual components, and I'm rolling it up into one composite indicator. That indicator has been on a sell signal pretty much all year long. Technically, the way that I do this is I will take the official reading on the first day of the month, so that's technically tomorrow after today's close. That said, there would have to be massive movement in order for any of these signals to flip to a buy signal. And right now, as I'm recording this, the S&P is fairly negative on the day. So it looks like the S&P is going to end the month on a down day. And we'll talk a little bit about that in just a moment. So right now, the VSI is still pointing to 0 out of 14. So 0 out of 14 buy signals. So that's the composite VSI. So now we switch into a daily candle chart. So this is the S&P 500 still, but these candles are now representing each day of the stock market. And I've got 3 dates marked here. One is to highlight the May 19th low. And then the next date that I've got marked there is the start of the month of June. And then the low of June 16th is the 3 dates that you see on the screen. What I'm trying to show is after that May 19th, the stock market, as measured by the S&P 500, did rally approximately 7%. And then we reached a resistance level, and the S&P fell back to create a new low. So it fell from about 12% from this high, pushed through this level. So we now have a new low down here on June 16th. The market then rallied another 7%, and we're going to talk about that level in just a second. Where we're at right now is we're approximately 4% away from this low. Now, as I'm recording this, again, trading is happening right now. And so last I looked, I think the S&P 500 is down about 1.5%, maybe 2%. So we could end the month only about 2% away from this low from June 16th. What I also want to show you is that this level where the May 19th level, we kind of created a bit of what we call a support zone, and then the market rallied, as we talked about, and the market fell off, and we were gaining confidence that this level was going to act as support because we had at least 3 touches on this level. Then the following day, unfortunately, it gapped lower. We put in this low, and again, now this level is acting kind of as a resistance level. So it will be fairly important to see what happens both at this level here, as well as whether or not we can reclaim this 3,900 level on the S&P 500. So obviously what we would like to see happen is we'd like to see July start off with a bang, and, well, sorry, no pun intended, given the Independence Day fireworks that we'll likely watch. But ideally, we would love to see July just start the markets, and its markets are rallying higher. Of course, that's true. An alternative that I would like to see is that we get a little bit more firming up. So if the market's going to come back down, I would like to see a retest of this low, and naturally we would like to see that test be successful. In other words, we don't push through that level. We'll talk a little bit about that in a couple of minutes. So this is the indices year to date. On the screen we have the NASDAQ as measured by, again, the ticker symbol in my software is CompX, so that's the NASDAQ, negative about 29% as of yesterday's close. This is small cap stocks, negative about 24% for the year. The S&P 500 as of yesterday, negative 20. Again, at the end of today, it might very well be negative 21 or 22. You can again watch our YouTube and Facebook and all those funds, and we'll post an updated chart. And then VEA is an international ETF that is just a good proxy for the international markets. That said, here we have single country ETFs. So now what's on the screen is a handful or a bunch of individual equities, individual equity ETFs or exchange traded funds that represent various countries. What I want to highlight is this right here, 2.59 and then negative points. What that's telling us is there's only one ETF, single country ETF that is positive year to date, and that is Chile. And if you watched our economic update webinar from a couple weeks ago, that's one of the stocks or ETFs that we talked about. The point is that's this red line here. And so if you follow the chart, I mean, that's not a very positive trend. So it's barely positive year to date. And the point that I'm really trying to make is it's pretty much ugly just about anywhere all across the globe. This is something that we're looking at on a regular basis, because if the United States market stays in a negative environment, but we find another country that is trending positive, well, as patriotic as we are, we would tend to want to shift assets into those types of countries that are in a positive trend, but it's just not out there right now. So that's what we're looking at. So just the other day on one of the social media platforms, I saw somebody that's in the industry, of course won't name names, but somebody in the industry was just talking about how bad the year was, and he ended the comment with, hey, just make sure you stay diversified. Well, on the screen right now is what we would traditionally see as a diversified portfolio, especially in your traditional 401ks, and 403bs, a company-sponsored retirement plans. Those types of plans really do not offer a tremendous amount of options inside of them, not most of them. There's obviously exceptions. If you have questions on yours, feel free to ping me or my team, and we would be happy to take a look at it for you. But the point is, by most definitions, when we talk to somebody in the industry and they talk about a diversified portfolio, they're talking about stocks and bonds, and within the stock environment, they also would talk about having international exposure, and they would frequently talk about having small caps as well as large caps. Well, that's what's on the screen. We've got bonds, we've got stocks, we've got small cap stocks, we've got international stocks on the screen. The diversification strategy is not working. And this is a point that we have been making for many years now, that the concept of the diversification is that when some things are trending negative, other things are trending positive. But what tends to happen is in these extreme environments, diversification doesn't work at the exact time you need it to work. And that's why we do things a little bit differently, why we manage money a bit more actively than what most people are doing, because diversification is great in principle, but when you need it to work, it doesn't, or it hasn't. It certainly hasn't this year. It didn't in 2008. It didn't in the dot-com crash either. So this is a pretty ugly chart. What this chart is doing is looking at the S&P 500 on a year-by-year basis every year that I've been alive. So on this chart on the right-hand side, you can see that I've got a handful of these numbers, but I've got every year on here since 1976. And the point that I'm trying to show is that this is the current year. We are showing that this is the worst year on record for at least since I've been alive. Now, as I was putting this together, I saw somebody tweet out that JP Morgan has indicated that this is the worst 6-month start since 1932. I didn't go back that far on this particular chart, but I am trying to highlight that this is a really bad environment, and it's the worst that it has ever been, at least as far as since I've been alive. This year right here, I believe this is 2020. And so yes, in 2020 it did start off worse, but in March it started to correct, and now it gets lost in this noise here. This, I believe, is 2000. Let's see, what year is that? The purple line is 2009. So again, in 2009, that's coming off of the global financial crisis. And so yes, that year started off pretty bad, but it corrected and the market started to move higher. The black line here, this is 2008. And in 2008, the S&P 500 ended the year negative 39.9%. So where's that black line? It's somewhere in here. So this is where we're at right now in the S&P 500, the worst start to the worst 6-month start, again, at least since 1976, but based upon some other technicians that I'm following, it's actually the worst start since 1932. Is the year going to get better? Are we going to turn up higher? I obviously have no idea, but this is just to highlight how bad the environment is. However, it's not all negative. One of the things that we have been talking about frequently through the years is that this is another way to be diversified, is to look at all of the various options in terms of what you can be invested in. So now what's on the screen are the various sectors of the S&P 500. So there's 11 sectors of the S&P 500, and this is consumer discretionary, that's communication, this is technology, that's real estate, that is the S&P 500, the average of all of them. There's financials, industrials, that's materials, healthcare, consumer staples, utilities. Again, utilities is a defensive sector that's also negative year to date. And then we've got energy. Energy is the only positive sector in the S&P 500 right now. But look at that nasty correction. We're going to talk a little bit about that in just a second. We can add to this one more, and I separated it like that because technically DJP is a commodity ETF. So commodities are not a sector of the S&P 500. But the point that I'm trying to make is if we are being active portfolio managers like we are, then part of our job, a large part of our job from a portfolio management standpoint, is to be looking for those pockets of opportunity and trying to find something that's in a positive trend. When we're managing money for clients, we're typically managing money on a discretionary basis, and so we're not trying to wait to get your permission to do something. You're charging us to go find something and invest in those things that are trending positive. So that is why we were very heavily invested in energy and why we were very heavily invested in commodities within our sector rotation sleeve of the portfolio. However, let's talk about whether or not the energy sector is now in a bear market. So on the top part of my screen, I've got XLE, that is the energy sector ETF. And on the bottom part of the screen, I've got the S&P 500. What I'm trying to show is here's the beginning of the year, so right in here, and you can see at the beginning of the year, the S&P 500 was turning over and it was correcting. And that's the year that we've experienced in a broad market basis. But look what was happening to energy. So that's why we were so heavily invested in energies, because it was the only sector that was trending positive. But again, let's talk about this little correction here. So let's now focus. This is just XLE. Let's clean up the screen. And what we're trying to show here is that from the high to just a handful of days ago, the energy sector dropped about 24%. By most standards in the industry, most people would consider that to be a quote-unquote bear market. Now, I'm not going to go there just yet because I don't like that definition of minus 20% equals a bear market. That's what we refer to as a lazy definition. I would contend that I think that, and that's key, I think this is just a correction from the trend has been so positive that we need to have some correction to it's like trimming your hedges. Okay, you need to prune every once in a while in order to keep the bushes healthy, right? And so I think that's what's happening here is we've just witnessed a pullback. It's been a fairly violent pullback just because the trend has been so positive. However, we can't just sit around and wait and hope that this is going to turn back positive. So for clients where we're managing money for them, that's why we're no longer in this position. Now, I would like to buy this back because I think this is going to continue to move higher, but that's speculation. I have no idea whether or not that's going to happen. So it's something that we're watching. All right, we're going to shift into a higher gear and burn through some slides fairly quickly because this video is getting a little long. On the screen is consumer sentiment. This is coming in right now, the official reading of 58.4, but there's an unofficial update from the University of Michigan that puts this statistic all the way down to 50%. I think 50.2 is the unofficial update. That would put it lower than it was in 1980 and the lowest it's ever been. That is not good news. Gas prices is certainly one of the reasons why consumer sentiment is so low. Average price of a gallon of gasoline across the nation is now more than $5 a gallon. One of the things that I've seen a couple of times is various folks have indicated that the price of gas is as bad as it is because of Russia's invasion of Ukraine. That is simply not true. Russia invaded Ukraine somewhere right around here, and you can see the rise in gas prices. That trend was already established well before Russia invaded. Now, Russia didn't help, but the rise in gas prices has nothing to do with Russia. This is the 10 and 3-year yield curve. The yield curve is indeed inverted. You can see on the far right side of the screen, it is a negative 0.01. We'll zoom in on that. I'm not going to belabor this point for right now, just to give you an update on where this is at. It is technically negative, so we would likely say that this is approaching the point where this is forecasting a recession. It's still kind of oscillating around that zero line, but again, that's really only important if you believe it's important about whether or not the government declares us actually in a recession. On the economic webinar that we hosted a couple weeks ago, I argued that it is entirely possible that we're already in a recession. And I also argued that we are already in a stagflationary environment at least. Now, that said, I say it's only important if you care if it gets labeled that, because again, what most of our clients are charging us with is managing their portfolio, and we manage our portfolio actively, and these are lagging indicators. These indicators of, hey, GDP is negative 1.5, and oh, by the way, this past week, the government updated the statistics, so the first quarter was not negative 1.5, it was actually negative 1.6. So these are lagging indicators. The damage has already been done in a portfolio. So if you haven't made changes to the portfolio, it's arguably too late. But this is not good news. So this here is popularized by, and maybe even created, you can see it's referencing Pring Turner. Martin Pring is an analyst that I follow. I read him at least once a month. And he argues that the business cycle has got 6 different stages, and he has been saying that we're in stage 5. I'm going to show you a couple of charts that would suggest that it is entirely possible that we've switched into a stage 6 environment, and we're also seeing evidence that we might be flipping into stage 1. Now, those are preliminary. Again, this is just educational in nature. Take no action on this. This is just something that we're looking at. But the point is that in stage 5, historically, we want to be selling stocks. And in stage 6, we want to be selling stocks, bonds, and commodities. So stage 4 is where you're selling bonds. Stage 5 is where you're selling stocks. And stage 6 is where you're basically out of everything. And right now, that's arguably where we are at. The question is whether or not we are going to return to an environment where we can invest in commodities. So again, on the screen right now is the Invesco DB Commodity Index Tracking ETF. Again, not a recommendation. I'm just using this as a proxy to talk about commodities. So commodities was in a very positive trend. We've already talked about that in this video. And it too, just like energy, commodities have gone through a little bit of a correction. Now on this chart, I've got 2 black lines drawn. Now what you can see is commodities have come back down, and right now, as of yesterday, the commodity, this particular ETF, is at this level. Again, you'll see this black line in just a second. I'm going to zoom out. So let's go ahead and do that. Let's zoom out. And now we got data on the chart all the way going back to 2006. And that bottom line that I was showing you is arguably a resistance level from 2013 and 2014. The top line is arguably a resistance level from 2012. And so the point that I'm trying to make is the commodities market has been on such a strong rally that by some measures, whether you're talking about the energy sector or you're talking about commodities, there's an argument to say, hey, it's in a bear market because it's come down like 20%, especially energy. My argument at the moment is that it is entirely possible that it is just a correction within a rally. Yeah, it's ugly, but it's generally these types of corrections are healthy. So again, something that we're watching to see if commodities begin to turn back up, because there is some suggestion that we could be in a commodities super cycle. And if that's true, we certainly want to be invested in it. But when it's correcting, we want to avoid some of that if we possibly can. Last couple of slides, I want to highlight this. This is our debt burden. I've talked about this for years. This is our national debt as a percentage of our nation's GDP. We are at 125% debt to GDP. This is very dangerous, and this is arguably one of the big reasons on why we have the inflationary problem that we have. And I haven't verified this, but this is a friend of mine that tweeted out this morning that the total federal interest for the past 12 months on our debt was $863 billion, and that is more than our military budget, and that is more than our Medicare budget. That is very, very dangerous indeed. Again, haven't verified that, but John tends to be pretty accurate. So that said, we're going to land the plane here. I hope you have enjoyed our monthly market monologue. Again, if you have enjoyed please give us a like on YouTube and share it on Facebook or Twitter or LinkedIn or wherever you tend to be, whatever social platform you tend to be on. We please ask that you consider sharing it with others. Obviously, if you have any questions, any comments, any concerns, by all means, feel free to reach out to me and my team. You do not have to be a client to ask us questions. By all means, send us an email. You've got my contact information on the screen. Again, hope you found this helpful, and hope you have a safe and enjoyable Independence Day weekend. Thanks for watching.